let's talk about equity compensation. Now, it used to be that the most common form of equity compensation was stock options, but there's been a quick transition over to restricted stock units, RSUs. Now, equity compensation is a great way to build wealth over time, and sometimes you can build wealth pretty quickly. However, but it's also a great way to blow yourself up if you're not prepared for the tax consequences or you're not managing risk appropriately. So let's talk about restricted stock units, RSUs. So what are they? Well, a company will grant you RSUs as a form of compensation. So you got your base, you got your bonus, and you have restricted stock units. And what that is what they are a promise. Companies is promising to provide you with shares of company stock at a certain point in time, provided you meet certain stipulations, the chief of which being you remain at the company for an extended period of time in order to get those shares. So let's take an example, right? Let's say a company is offering you $200,000 in RSUs. Now, when you receive those shares, will the package be valued at $200,000? Well, the answer is probably not. They won't. Either be more or it'll either be less. And why is that? Now, this is how typically it works in many situations, but you got to make sure that you read your grant documents so you know exactly how it works in your particular situation. You can always read through that with an advisor or a planner, but this is how it typically works. So you have a $200,000 RSU grant. That is based on a specific share price at the time of grant. So let's say $200,000 based on a share price of, let's call it $100 per share. So what you're really getting, what the promise really is that you'll receive 2,000 shares, 200,000 divided by $100 per share, 2,000 shares of stock at a certain point in time in the future. Right? And that's key. That's key. Because if at vest, when you are distributed some of that stock, the share price is over $100, well then your package is worth more than $200,000. That's great. You're making a lot of money. You are building wealth. Tell them to bring out the lobsters. However, if that stock price falls below $100 when those shares vest, then your package, your $200,000, is now worth less. It's worth less than $200,000. And that's what we're seeing a lot these days. We're seeing a lot of times, because we've seen such pressure in stock prices year to date. I mean, some stocks are down, 25, 30, 35, 50% even from grant. So you might have thought that you had a $200,000 RSU package. Come to find out, once those shares start to vest over time, that package is worth more like $100,000. And that's tough. That's painful. But that's the name of the game, right? It's all good when the stock price is going up, and it's painful when the stock price is going down. You don't want to spend money that you don't have, so you have to plan. You have to plan accordingly. All right, so it's mentioned vesting a couple of times. So how does that work? Well, typically, the vesting period, so that's the period in which you are distributed, the time in which you're distributed those shares of company stock, is on a vesting schedule. And a lot of times that vesting schedule can be 3, 4, even 5 years. Over that period, a portion of your shares will vest over time, right? Maybe let's call it a 4-year vesting schedule. 25% will vest per year, right? So you have 2,000 shares after the first year, 500 shares will vest after the second year, second 500 shares will vest, and so on and so forth till after the 4th year, all the shares will be vested, right? You'll get distributed all of those shares, and you're going to have to make a decision when those shares vest. Do you hold? Or do you sell? Now that's a tough call. That's a tough call. And I can't give you recommendations there because I can't give specific investment advice. You have to think about your overall specific financial situation. How much risk are you willing to take? How much risk do you want to take off the table? Do you need the cash? Do you not need the cash? Now, this last point that I'm going to make, here today is taxes. Right? How are RSUs vest? Or how are RSUs taxed? Well, they're taxed not when they're granted to you, not when the promise is made. They're taxed when they vest. when they vest, they're taxed just as your ordinary income, just as your W-2, just as your compensation is taxed, right? And just like your paycheck, just like your compensation, there is money withheld, shares withheld in order to pay federal income tax. Now, that can generate a significant tax liability if you're not careful. You may think you have all this cash. Come tax time, you could easily owe $10, $15, $20, $30,000 in additional tax because not enough was withheld. Now, we'll get into taxes later. It's deeper than kind of this surface level, and you got to plan for it. But that is how RSUs work. So go ahead and continue to build wealth, and we'll be back to talk about more with restricted stock units and equity compensation. I hope you have a great day.